Hey everybody, happy to see you here. Welcome. So I'm just gonna test the audio here. I'm pretty sure everything's working pretty well. Checked everything ahead of time, and it's good to be here. Happy Sunday evening to you. It's Sunday, May 15th, 7:03 p.m. Central Time. Checked everything ahead of time. There we go. It's good to be here. Happy Sunday evening to you. It's Sunday, May 15th, 7:03 p.m. And that's the audio. I double checked it. I triple checked it. It probably echoed for a second, but then we're good to go. So it's been what an exciting time. It's been a difficult time for some. Navigating your way through the crypto crash, I think, has been the most difficult thing. And I know that there are some of you here probably who lost some money in that, and I just want to say, give you my condolences. Talk about a little bit about crypto and what I'm doing now, but I want to mainly focus on the next big sort of black swan trade that I think people have sort of forgotten about. And then we're just going to focus on that one because it's the next big trade that I want to do. And so with that said, I'm going to share my screen and I'm going to just share my, let's see here, just my browser window. This will work perfectly. And there we go. Yeah, this should be perfect. Okay, so I'm going to kick things off with a look at Doge, and I'm sharing my screen, and I want to share my screen like this. There we go. Oh, okay, awesome. So Doge, double bottomed here, and it's not the main one, but it is one that I have, and I'll just share my stuff here. As many of you know, I've got PayPal, Palantir, SoFi, Robinhood, Google. I don't plan on selling those anytime soon. And I tweeted this out. I think I also mentioned it. I bought $1,000 worth of Doge the other day. And I don't think this is a black swan trade. I think this is just a regular colored swan trade. And I'm looking for this just to get up to like 10 cents. I'm not looking for anything substantial. I would love it if it could make it halfway the distance to this month's pivot. Maybe at 11 or 12 cents, that would be really great. But that's not my trade. That's not the main trade. That's not the one I want to talk about today. What I want to talk about today is GLD. I want to talk about gold. So in the midst of all this inflation stuff, the gold miners, what is it? The GDXJ, right? Is that the one? Yep. The junior gold miners, like in the midst of the stock market crash and crypto crash, gold miners, because they are stocks, everything falls. So I get this question a lot, like in a market crash where gold is supposed to be a store of value, a hedge against inflation, and maybe even a hedge against market crashes and whatnot. Why doesn't gold do better? And the answer is because, well, there's a variety of reasons, but GLD is an ETF and the GDXJ is just an ETF full of stocks. And when there's a stock market crash, all stocks go down. And very, very few stocks will beat that or will be any different from the rest. So this leaves what I think is a somewhat massively incredible opportunity. Inflation isn't going away. In fact, even though we are possibly headed for a recession, it takes a while. Well, we are headed for a recession, most likely. Um, Inflation is still a real thing. So before we get into the meat of the trade and the reasons behind the trade and the analysis, and then the counter analysis to balance out the view, I just want to remind you that all trading involves a substantial risk of loss. Trading is not a suitable endeavor for every single person on the planet. This is not ratatouille. It's not like everyone can cook. And the reason that most people disqualify themselves uh, as traders, and this is my opinion, isn't because they lack education, and it's not because they lack a career on Wall Street. It's because they lack discipline and they are somewhat impulsive. And to the extent that I have lost money or made mistakes, that's been the reason. I have impulsively entered trades that are too large, stayed in losing trades too long, and those kinds of things. And those are the real dangers. And those are the battles that that we fight every day if we want to be traders. So please remember that past performance is not necessarily indicative of future results, and nothing in this presentation is intended to entice you to buy any particular financial instrument. So with that said, I just want to do some analysis, and I'll describe to you the trades that I'm thinking of taking. I am particularly interested in gold for technical and fundamental reasons. As you know, inflation readings are pretty much off the charts. They're stronger than ever. Inflation is strong. The inflation is caused by financial distortions, by the Federal Reserve increasing the money supply dramatically, especially in 2020. They just massively increased the money supply, and you just cannot, generally speaking, get an influx of money into the system without eventually raising prices. So energy is more expensive, food is more expensive, durable goods are more expensive, cars are more expensive, homes are more expensive, everything's expensive. And now loans are becoming more expensive. Everything is becoming more expensive. And while gold isn't necessarily the hedge against inflation that it used to be, it may still be one of the best. And I'll give a counter analysis in a moment, but I want to focus on the possibility that it is a store of value and will hold its value and maybe even increase. So with that, let's take a look at that's the fundamental. Inflation is here, inflation is rising, and we gapped down on the daily, and I will zoom in here in a moment so that it's all very much more clear. But we're back testing a trend line that was created from the May 2021 highs, and then the November highs, and then the January highs. We broke that, but then we bottomed out on the trend line that connects the low from December to the low from September. And the next lowest level is 165, 166. I think it's now possible that we do hit that level. And if you look a little bit further out, that wouldn't surprise me at all. And we would still be making higher lows, so to speak, anyway, and we would have a chance. If gold is a store of value and a hedge against inflation, which are possibly not true, we should see a bounce off of either the trend line that we're at now, or we should see a bounce off of the trend line that is below at 165, 166. Now we're so close to it that I really don't care anymore. And here's my plan. My plan is now to buy. Let's just make some notes on the screen here. Remember, all trading involves a substantial risk of loss. I am not here to entice you to buy anything. So 60-day expiration, call options, out of the money by 20%. So I'm looking to buy calls, which are 60 days out and out of the money by about 20%. So 20% of 170 is $34 out of the money. So let's just round that out to like a $200 calls. Now, you might be saying to yourself, that's got to be the stupidest thing I've ever seen, Rob Booker. There's no way gold is going to make that kind of move within a 60-day period of time. Well, let's take a look. In January of 2022, gold was at 166. And then within about a month and a half, gold had risen to 193. An option that was bought that was about $30 out of the money would have been very unlikely to pay off. And when gold started its incendiary, savage, trending climb, that option would have paid pretty well, actually. So let's take a look at what options are out there and on the options profit calculator, which will give us not a perfect idea of what it might be worth, but it's going to give us a general idea. And remember, black swan trading is really not something that retail traders do very well. It's something that most of us don't even understand. A lot of my ideas were influenced by Mark Spitznagel's the Tao of Capital, and yet at the same time, I have to admit, and I have to disclose. I mean, I can even just read some of these quotes. Anyway, I'll read it later. He says over and over and over again in YouTube interviews and whatnot, he says, listen, this is hard stuff and most people don't know how to do it and most people won't be able to do it. And I think that's fair. I think it's just being real. So GLD, it's the ETF. It makes it easy to buy options. And let's buy an option. We're in May, so let's go out not to June. Let's go out to July. So let's go to the 15th of July, and let's do the $100, excuse me, the $200 strikes, 36 pennies. And let's buy 3 of those to spend $108 to give us an idea. So let me just do this and increase the size so you can see it. And then let's say that within 60 days, it goes from 180 to 195. And then we'll click calculate. Maximum risk is $108. There's no way that I can lose more than $108. And my maximum return is infinite. And that's just, well, obviously not going to happen. But if gold does skyrocket, then, it'd be something. The probability of profit is very low. It has got a probability of returning at least 1 penny at the time of expiration. So we are not talking about high probability trading. We're talking about low probability trading. Gold gets to 195 in, let's just say mid-June. It's a 9-to-1 reward to risk trade. That's kind of a bummer to me. I want a reward to risk that is much, much bigger than that. I want something that is going to pay way better than that. But as it stands, that's just the way it is. This is not one of those stupendously gigantic payoffs. And the reason for that is I'm buying too much time. I'm buying all the way into July. And if I buy less time, the trade will become a little bit more profitable. So what I'm going to do is change it up a bit. I'm not only going to buy the July 15th call, I'm also going to buy, so let's just zoom back this way. Let's also buy the June 17th calls. And you can see here, these are much less expensive. These are like 11 cents for the 200s and 16 cents for the 195s. And I'll buy 6 of those and spend $96. So I'm going to always have the 30 days and the 60 days going. Every month I'll buy them. And this is going to pay much better. So this is $100 of risk to possibly make potentially something around a 20-to-1, 17-to-1 return. Now that's much better. This is getting closer to the kind of thing that I like. Now, both of these are very, very unlikely to make any money. They have less than a 1% chance of success. What if I also at the same time started looking at buying less time? Now, I'm probably not going to buy less time. I've done this before, but I'm probably not going to do this. But I just want to give you an example. What if I only buy options that expire in a couple of weeks, and I buy the 195s? I'm going to spend 3 cents. 194s are 3 cents. I can actually buy the 189s for 5 cents. I can actually buy the 187s for 6 pennies. So I'm going to go ahead and buy something nearer to the money. And I'm going to buy 18 of these, 18 of these. Yeah, $108. Perfect. And then I'm going to calculate this. And by buying less time, look at what the numbers do here. Look at these numbers. Now we're at risking $100 to potentially make, if it really goes all the way to 195, $14,000. Now, the probability of success is less than 0.1%, but the payoff is 140 to 1. Now, let's walk through some principles here and talk about the realities associated with this. What we're looking at in these instances, we are looking at things that are unlikely to happen, but will be such a shock when they do happen, or if they do happen, that they will pay a significant amount of money because they are so unlikely. Now, is it possible that gold can even go that far? Well, gold in a 4-day stretch of time went from 179 to 193. It went 14 $14. So it has gone $14. So what if it did get all the way up from 168 to 183? That's a $1,500. That's a 15 to 1 gain. That's pretty significant still, for a move that is possible and has been historically, it has been done. Gold has done it. And in fact, on some occasions, gold has gone from 170 and 4 days later to 178, and then maybe 2 weeks later to 189. So $20 gain. So it's not unheard of. This does happen. That move happened in 2020. So the money supply increased so dramatically that inflation concerns were amplified and gold just went kind of out of control. There's no reason to think that that can't happen all over again. It's just that most people don't prepare for it. And because it's unlikely, people don't, in my opinion, people don't price it correctly. Okay. The risk here. So let's start with the risks. The risk is that I'm going to lose $100 every time I take this trade. And I'm not planning on taking this trade with $100. I'm really kind of planning on taking these trades with $500. So say I put $500, so 18. I'm going to do 18 times 5. I'm going to buy 90 of these, $540. Perfect. Calculate these. So the return is $500 for a $73,000, $72,000 payoff if gold just goes on some kind of a massive, massive run or some crazy stuff like that. Now you might be saying, wow, Rob, that's stupid. Yes. In the eyes of the general public, this kind of trading will always look stupid. And it is kind of stupid because we don't have the same instruments available to us that professional black swan tail hedging, central bank hedging investors do. We don't have the same products available that Mark Spitznagel does. We can't trade derivatives of options on options. We can't do that. We don't have those available to us. We can do butterflies and all kinds of really interesting types of trades. Taleb goes into this a little bit on his Twitter feed and in some videos that are I spent, I don't know, hours watching these over and over and over again just to understand them. And you can stagger those out and simulate that kind of a thing, but it's complicated, difficult, and so I'm left with something that admittedly Taleb and Spitznagel and others just don't think is possible, and that is timing the market. So because black swan trading is typically something you do, typically it is something that you do every single day or on a rolling basis all the time, and you're not trying to time the market. And these guys will lose, in general terms, they're willing to lose $100,000 a day to make $500 million on a given 2 or 3 day stretch of time. We don't have that. We don't have the luxury of buying options every single day that are going to lose. Although if you wanted to, let's show you what this looks. This is not what they're doing, but let's buy options with even less time. Watch what happens when you buy less time. Say we buy 20th of May, and we buy, let's say we buy the 180s, and we buy 100 of them, spend $500. Now we calculate this, spend $500 to potentially make $150,000. Because we've bought less time, we get paid so much more money. We get paid so much money when we buy less time. So the less time you buy, the more money you make. The less time you buy, the more likely it is that your trade is going to be garbage because you're not giving yourself enough time to win. So you have to buy this week's, next week's, and then next Monday you got to buy this week's. You got to buy next week's and next week's. So you always have, 2 weeks out, and you're likely to just run out of money before your trade pays off. That's what is likely to happen. And even if you get it right, and Spitznagel explicitly says this, and he says it in Safe Haven, he says it in the Tao of Capital, he says it a lot of places. even if you get it right, you might still not make any money. Imagine this. Imagine I'm always buying 2 weeks at a time, but the trade happens all on one day, and we're so close to expiration, or it's on the day of expiration that our trade doesn't make any money, or it makes 20 to 1 instead of 1,000 to 1. That's a real bummer. That's a real bummer. And so you can get it right and still actually lose money. So why would I still do any of this? Well, before I tell you why I'll still do it, and I think I've now disclosed a lot of the risks. The other risk is that the main risk is that we get the trade right and we still don't get paid. The other risk is that we don't get the trade right and we go 52 weeks and we run out of money and or patience, and then we give up on it, and then it goes and does exactly what we thought it was going to do, which is this is what happens to a lot of people. If you look over the course of your trading career, some of your losses that you took were because you traded too big, but you got direction right, but you traded too big, so you couldn't stay in the trade. All right, those are all the risks. There may be no inflation. Gold may fall. Gold may not be a store of value anymore. And this whole thing might just be the stupidest thing you ever heard in your life. Okay, great. Got it. Good. Okay, great. We're all in agreement. This could fail. This is possibly stupid, and there are no guarantees. How can I do a better job of possibly timing this trade? There are two ways that I have in mind. One is I'm going to wait for, well, I already waited for it. One, I wait for it to hit this trend line and take the trade tomorrow morning. Okay, so now I'm going to do the trade. I'm going to actually buy a week, 2 weeks, and 2 months. I'm going to do all three of those things. And I'm going to keep doing that every week after week after week after week. And I will eventually stop. But I'm only going to put like $20 to $50 into those trades. Very, very limited, very small amounts of money so that I've always got some skin in the game. That's my plan. Now, I may fail, or I might get sick, or I might be on vacation, or something might go wrong. I'm also going to do the same thing if it falls a little bit further. I'm also going to do the same thing if it falls a little bit further. And I'm really not going to do any kind of extra trades. And I might even stop doing the trade if it falls. And I'll wait until it hits a bottom. Now, remember, it might hit a bottom and then it might start moving, but it might not move enough to ever cause my options to increase in value. It's possible that the volatility won't spike enough for the options to become valuable in the time, so that's the danger, but it's the only defense that I can see in doing this. I'm going to do the old Booker pre-market situation. Now, many of you who are members of the Sunrise Club or who have had access to pre-market trading stuff, you have seen me do this before. And now what we're going to do is we're going to open up GLD, and I'm going to show you what I might do. Well, I am going to do this. I'm going to, every day, keep levels on the pre-market highs. And on days, so let's say that instead of falling on this day, gold actually broke the pre-market high, and it did it on significant amounts of bullish volume, something that looks like that over there. On those days, I'm going to pile into the trade with like 5 or 10 times the usual amount. And I'm going to try to time the trade. So on a day like this, where gold breaks the pre-market highs, I'll spend $100 on this week's and next week's options instead of $20. And then I'll set myself up for a possibility of some success. And I'll just do that every once in a while. And it'll only happen when the market gives me an opportunity to do it. And if gold is continuing in a downtrend, it really won't matter, and it really won't fire off very much. And I'll just keep those small trades going. Last of all, This is my plan. I am not promising you that I'm going to do it, but I am very likely to do it. On Friday of this week, I will most likely buy about $50,000 worth of GLD. So I'm most likely between $50,000 and $100,000 worth, so that this trade does not depend solely on options increasing in value, that I just have some straight up exposure. And I might say that my max is 100, and I might go 25K at a time as it hits these levels, and only add when it breaks through those pre-market highs. That way, even if the options don't pay off, let's say in 52 weeks, let's say I lose $100 a week on average, I would lose $5,000. Let's say I even lose $200 a week, I lose $10,000. So over the course of a year, I might lose $10,000 for the chance to make between 50 or whatever $1,000. Plus, if GLD jumps and my options don't go into the money because of the way that this trade is structured, the GLD trade will still make money, just not even on margin, just cash. Okay, so that's my trade plan. That's my Black Swan trade. I don't have any other Black Swan trades planned. I don't have any other kind of thing that's even similar to this going on right now. This is the only one on my radar. That could change, and if it does, I'll pop in on YouTube and Facebook and everywhere else. So, last of all, I love being back on Facebook in particular. So if you're watching this on the Facebook Rob Booker Trader channel, leave a comment, and I will send someone who comments on the Facebook video a copy of The Tao of Capital by Mark Spitznagel. If you already have that, I'll send you a copy of one of Taleb's books. And then we'll do the same contests during this week on the YouTube channel as well. You might also recognize that the YouTube channel's name has changed. And if you're wondering why that is, a few years ago, I sold my YouTube channel and committed that in 3 years, the company that bought my YouTube channel could change the name of the channel. And they so did. And I'm excited to see what they do with the channel as well. And I will, of course, be contributing to it also and helping them out when they need it. But you'll recognize that there's a different name on there. Okay, love you all. Can't wait to see you in the Sunrise Club if you join me over the course of this week. I'm excited to be here. Thanks for watching, everybody. Thanks for being here. And those of you watching on Facebook, leave a comment, say hello, tell me where you're from, ask me a question or whatever on Facebook, and I'll reply. And one of you, I'll send you a copy of the book. Okay, bye for now.